Well, welcome everybody. Thank you for coming out to our monthly business forum. My name is Steve Ghani, and I work for the City Economic Development Department. So we've started this, I don't know how many of you have received our emails and actually clicked on the businessforum.org, kind of seen our speakers. We have a Facebook page, but that's great. Show of hands, little by little, we are trying to see what is the best way to reach out to not only residents but local businesses and even those who are adjacent to us and just really want some business resources. So what we've tried to do is get some awesome keynote speakers that have strengths in different areas. This month, we had the opportunity to listen to tax manager from Anderson and Bradshaw. He's also a local resident, Eric Dow, so we're excited to hear from him. But before we turn over the time to him, we just wanted to do some brief introductions. See which businesses, which people. You don't even have to have a business. You're just interested. Feel free to attend. So before we go on to our keynote speaker, why don't we start from Lamont. Lamont, would you just share a few words of business and promote what you do?
Okay, well, my name is Lamont Snar, and what I wish to promote, and I have some flyers back there, is Toastmasters International. It's a club-based program developing your communication and leadership skills, way to find your voice. If you're in business, you're out, you're talking to people, you need to be able to think clearly and communicate concisely. So we have a structured program for developing those skills. And again, at Toastmasters, there's some flyers back there, and I'm Lamont Snar.
I'm Brian Mills. This is my wife Lindsay, and we represent two companies. I mainly represent B&L Online Promotions. I do all the marketing and web development stuff for our main business, but I also do consulting on the side. And I've been doing it for the last 10 years. And I'll have Lindsay explain the Dress Up Shop.
I'm here for the Dress Up Shop. We have an online retail store. We sell kids dress up clothes and princess costumes and boys pretend play stuff. And we do have a local store here now, thanks to the incubator program. We have our take walk-in customers, but primarily we do online sales.
My name is Keith Brown. I'm a speaker, trainer, coach, and I'm just out here really visiting Scott here.
Well, my name is Scott Pym. I specialize in social video marketing. Lamont had actually invited us to come out here and kind of share with you guys what we do. I do a lot of YouTube video production work. I do all the monetizing, partnership programs, things like that. Keith's actually one of my friends who's a part of Toastmasters as well. Great organization to be a part of. You guys want to learn how to speak and get in front of people. So my name is Scott Pym. Thanks.
My name is DeRay Preston, and I'm an attorney. I have a law firm with two other women. We all work from our homes as much as possible, and my home is a stone's throw away from here. We work primarily in the area of family law and some estate planning.
Okay, well, kind of already said, I'm Eric Dow, the Anderson Bradshaw. I do tax consulting and planning as well as compliance and QuickBooks consulting. And I'll explain a little more when I get my presentation in a few minutes.
My name is Wendy Logic. I am a resident here in Eagle Mountain. I personally just undertaken my first business independently of my husband. I purchased the Crossroads Journal. It's a bi-monthly publication. My husband and I have a few rental properties and car dealership, and so this is kind of my new adventure, and this is my first time here.
Is it just me? I just started a clothing boutique. I realized that a lot of women in Eagle Mountain don't have the time to drive all the way to American Fork, so I like to do clothing shop. So I opened up a little shop in my home, and then I put it on the web so that we can ship. So I mostly do sales online, but yeah, it's just started this summer.
Thank you, Jody. And Jason Walker, he's our assistant city manager, so any complaints or suggestions, feel free to talk to Jason Walker. So economic development, any questions you have with any offices, potential businesses or companies, if you want to have a business or company come in, feel free to talk to me. Also, just zones or any other questions. Also work with the business incubator as well. Lindsay and Brian is one of our rock stars. They started in their basements with only maybe 500 square feet in the basement, bursting at the seams. They quit their primary jobs because the business was so successful. Now they're in the incubator and they're doing some miracles out there. So visit their shop, look what they have. If you're in need for anything, they know the answer to it. And also our video cameraman / business resource counselor, Sean Wilson. He's here Mondays and Thursdays from 8 to 5, and he's also in the business incubator. So he's a BRC counselor, he's a full-time BRC counselor. He's there with any questions, if you need help on financing, business plan, whatever it is from A to Z, he's there to help you. He's very well-versed in that. So now, we just want to thank again all of you for coming down, and Eric Dow, take it away. Appreciate you.
Thank you. Okay, so I'll introduce myself a little bit more. I actually grew up in Maine, and I came to Utah to attend BYU. I did my undergrad and my MAC, Master's of Accountancy, at BYU. And then actually before I graduated, I started working for Anderson Bradshaw as an intern, and then started full-time after I graduated. And then I got my CPA license a year after that, so I've been a CPA for 4 years now. And I've lived in Eagle Mountain for 5 years. The last 3 years I've been also a member of the city's Economic Development Board. And let's see, so Anderson Bradshaw, we're a full-service CPA firm, and there's some cards and brochures on the back table there as well, and some pens. So we're a full-service CPA firm. Our office is located up in Salt Lake at 53rd South, and but obviously I live here. It's worth the commute. I love Eagle Mountain. I love living up here. And I'm a member of the Lehigh Area Chamber of Commerce, and we have a number of clients in Utah County and in Eagle Mountain, and I'm focusing my efforts on growing our client base in this area. So I am the tax manager at Anderson Bradshaw, and so like I said, I focus on tax planning and consulting, as well as the compliance and QuickBooks consulting as well. So with that, we'll go through. I have quite a bit of information in the slides here, more than we'll have time to go through probably today. So some of it we'll skip some of the details and just hit the highlights, so you at least are aware of the issues that there are. And that's the biggest thing is to be aware of what issues there are, and then you can always investigate and figure out the details later. If you don't even know there's an issue, then probably isn't completely right. Okay, so we'll start with the basics here. The first thing is your choice of entity. When you're forming a new business, or you can always reevaluate. Sometimes your needs change, and you need to change the entity structure down the road. So the basic forms are sole proprietor, which is a Schedule C, is what you file just on your individual tax return. And then there's a single member LLC. You can either, by default, you would file a Schedule C on your individual return, or you can also elect to be taxed as an S corporation. And then multi-member LLC, by default, is taxed as a partnership, but can elect to be S corporation. And then if you form an actual corporation, you can either be C corporation by default or elect to be an S corporation. And so if you just start a business, by default you're a sole proprietor. You haven't set up any legal entity. And then the most common for a small business startup when you do form Usually it's an LLC, that's the most popular. And so an LLC, either, as we see it there, it's either a Schedule C in your individual return or a partnership return if there's more than one owner. So one common strategy to reduce your self-employment tax is to elect to be taxed as an S corporation. So we have let's see, the next slide there, I'll show you a quick calculation of how that can make a difference. So it's with the owner's compensation that an LLC is taxed, you pay the tax on your individual return, and you have self-employment tax, which, if you're working for an employer, see in your pay stub you have Social Security and Medicare tax, and the employer pays an equal amount, and that combined, if you're self-employed, you get to pay both parts. And so that's a self-employment tax. And so by electing to be taxed as an S corporation, you pay yourself a salary of only part of your income. You pay the self-employment tax on that part, and you can avoid it on the rest of your income. So, for example, we have an LLC that's taxed as a partnership versus making an election to be taxed as an S corporation. If you have your net income before your own salary is $100,000, by default, you pay on the left there in a partnership, you pay 15% self-employment tax. This is a simplified example, but just to illustrate your point, you pay 15% versus as an S corporation, you pay yourself a salary of $50,000, so the corporation gives you a W-2. The other $50,000, you still have to pay your income tax on, but you avoid the self-employment tax. And so in the middle there, you can see the self-employment tax goes from $15,000 down to $7,500. And so that's a pretty significant tax savings for a pretty simple tweak to your structure that doesn't really affect your day-to-day operations. And so it's little strategies, little things like that can make a big difference if you're aware of that. Okay, so then a common way to reduce taxes also is to defer your taxes through retirement savings. So the easiest, simplest way is to contribute to an IRA. And the downside of that is that there's a cap of $5,500 a year that you're allowed to put in that. And you can do both for husband and wife, even if only one is working. So then with the traditional IRA, you get a tax deduction today, and then you'll pay the tax in retirement when you pull that out. Or with a Roth, you can do the opposite, pay the tax now, not have any tax in retirement. So we'll go through touch on a few different versions of retirement plans there are. So if you're wanting to put in, to save more than that for retirement, there's a simple IRA you can set up. That gets you a little bit higher limit. So you can defer up to $12,000 and do an employer match. And you also have to offer that to your employees if you have other employees. So that gets you a little higher. And then 401k is another option, which I'm sure everyone's familiar with. And so that one gets you can defer up to $17,500. Take that deduction this year. But as a self-employed person, you can also do an employer match. And so if you match your own, you also have to match some for employees. And so, there's some more detailed planning you want to do there. But if you're the only employee, for example, without matching anyone else, you can contribute up to $52,000, including the 17 plus the employer match. And then there's another option that, if you want to save even more money than that, I don't have a slide on it, but I actually had a new client come in yesterday, and he's about to just a few years away from retirement, and he's always done his own tax return by hand, printed out the forms for, he has his own business, and he's filled it out, by hand every year. And his family finally convinced him, you need to go talk to CPA, see if there's anything else you should be doing, make sure you're doing this right. And yes, he was doing it right for for he was reporting it correctly and paying the appropriate tax. But there's he makes a lot of money, and there's another plan that's actually a pension plan that we have a defined benefit in retirement. And so we started the process yesterday of setting him up with that, and he's going to save $150,000 on his taxes just this year, for a few years. So that was the first time this ever happened to me. But I thought that was pretty exciting to have someone come down and say, yeah, you can save $150,000 just between now and the end of the year. Okay, so fixed assets that's when you purchase something that's going to last longer than a year, like a piece of equipment or a rental property, a computer, and there's lots of other examples. And so instead of just taking a deduction as an expense for that item, you have to depreciate it over a number of years, generally. And so, like a computer, you deduct the cost over a 5-year period. Or if you buy a residential rental property, you can deduct it over 27.5 years. So each different kind of fixed asset has a length of time that you can deduct the cost over. But there are a few provisions that allow you to do that faster. So one is bonus depreciation, which is just through bonus depreciation is one of the things that Congress kind of plays with every year. Sometimes it's 100%, sometimes it's 50%, and it might go away for a few years, and it might come back. So we never know. So currently, for 2013, it's 50% bonus depreciation, and that's set to expire and not have bonus depreciation in the future, unless Congress passes something for next year. So that means when you buy a piece of equipment that's $20,000, you can deduct $10,000, 50% of it this year, and then the other $10,000, that's the piece that you spread out over 7 years, or however you apply to that item. And so for the bonus depreciation, it does have to be a new piece of equipment or a new asset. And then another one is Section 179. For that one, it doesn't have to be new, and you can deduct the entire cost this year, as long as you have positive income that you're deducting that against. Let's see.
Can I ask you a quick question on what's
Sure.
For startup businesses in your first year, can you pretty much deduct all of your startup costs all at once if you choose Section 179, or you can do the depreciation scale, right?
For purchasing equipment and
Yeah, like like if you start up, sometimes they elect us to write it all off in that first year. That's only a one-time thing, right, for startup businesses?
The Section 179 applies to all businesses.
Okay.
In any year.
Oh, okay.
Yeah, but you do have to have positive income that you're offsetting with that deduction.
Okay.
So if you're a new startup, and often new startups don't make any money the first year, so So then you can't take 179 to get to a loss.
Okay.
And auto usage is a common question people have. And so when you use a vehicle in your business, there's basically two different ways you can deduct the cost. So one is a mileage per diem that's currently 56.5 cents per mile. And so you record keep a mileage log, take your total miles for the year, times 56.5 cents, and that's your deduction. And there's some documentation requirements there. And then the other method is to deduct the actual costs. So you deduct your gasoline and maintenance and also depreciation on the vehicle. And so depreciation, again, you can spread it out over 5 years. And there's limits for, depending on what kind of vehicle you buy. You buy everyone always is asking this question. So if you buy a vehicle that's over 6,000 pounds gross vehicle weight, so that's usually either a truck or a larger SUV will meet that, then you can deduct up to $25,000 of depreciation in the first year. However, that's not always the best answer. It sounds great to have a big deduction this year. Do you have a question?
No.
Oh, sorry. Any questions as we go, feel free to ask. So here's an example of the auto expenses. So the bottom line is the mileage deduction. Everything in the middle is the actual expenses. So assuming you drive 20,000 miles a year for 5 years, the first year you get that $25,000 deduction plus your gas and maintenance and insurance. So you get your total actual cost, you can deduct $28,000 the first year versus the mileage you would only be able to deduct $11,000. However, then the next year, you don't have that depreciation. So this is assuming the vehicle cost $25,000. That was the whole cost. And you don't have any depreciation the next year. So your total actual cost might only be $36.50 versus that same $11,000 you just left with the mileage. So on the front end, actual seems better, but over the long run, in this example, the mileage is actually better over 5 years. And so it's just important to be aware of the different options you have when you buy a new vehicle. Estimate what the costs are going to be and how long you're going to keep the vehicle to determine which one is actually going to be the biggest deduction in the long run and not just for this year. Another tax planning strategy is a cost segregation study. So this applies to real estate. If you buy, residential rental is 27.5 years, but all commercial real estate is 39 years, is the time frame that you deduct depreciation over. However, when you buy a commercial building, for example, there's lots of things in that building that you could, or that technically aren't part of the real estate. And that gets pretty technical, but the carpeting, for example, is, you can depreciate over 7 years, or certain light fixtures, even certain wiring. And there's all kinds of different elements of the building that, according to the tax code, aren't technically part of the overall building. So you can take those deductions over a shorter time frame. And even if you already have the building, if you own it for a few years, that doesn't mean you missed out on this. You can still do the study and catch up the depreciation down the road. So for example, there was a warehouse building with this cost segregation study, the result was they could take, and this was for 2012, they could take an extra $130,000 of depreciation in that year to catch up those pieces that they'd been spreading out over 39, but they could have, over 7 or 5, which was already passed, they could make up the difference this year. And so that saved them $52,000 in taxes for that year. And, so of course they take those deductions now, and they don't have them later, but have the benefit of saving taxes now. And so the present value was $34,000 for that building. So generally, if a building costs $300,000 or more, whether residential or commercial, usually if it's above that, then it would be worth doing a cost segregation study. Another item that sometimes people aren't aware of is the per diem for meals. If you travel for business out of town, rather than keeping track of your actual meals expense, you can just use a per diem, take that as your tax deduction. And the amount varies depending on the city that you're in. But then you don't have to keep track of all the receipts. I still recommend that you do keep them, but as far as the tax deduction, you just take a standard amount. So, depending on your spending level, that could be a lot more than what you're actually spending. It's depending on the city, it could be $75 a day for food, and if you're on a tight budget, you can spend a lot less than that, but still get the deduction for the per diem amount. So, home office. This is an area that lots of people get excited about. In the end, it doesn't usually save a significant amount of tax, but it saves a little bit. The biggest hurdle is that the area of your home that you designate as your home office has to be used regularly and exclusively for business. So it's the exclusive part that a lot of people don't qualify for. So if you're putting together, assembling something in your living room every evening for your business, of course you use your living room for personal time as well, right? So that's not going to qualify as exclusive use. But if you have a dedicated office or corner of a room, that has your desk that you only do business at, for example, then that would qualify.
We're moving the production in the garage, right?
Yeah. Yeah. And if you only use your garage for that, then that can qualify. And for storage too, if you have an area of your home that you store your inventory in and you don't use for anything else, then that can qualify. Okay, and then, so here's a laundry list of expenses that go into the home office calculation. And for these, you take the portion of your home, so if your home is 2,000 square feet, and you have a 200 square foot business use area, then you take 10% of all these expenses. And that's to give your home office deduction. And there's another strategy where you can have your business pay rent to you individually for the use of that piece of your home. And then if you have positive income in that, it can convert ordinary business income into passive rental income. It's not subject to the self-employment tax. And there may be some other benefits to doing that, depending on what other things in your tax situation. So that's an option. That's a tool that can be used. And then brand new rules for 2013. You can still use the old method or you can use a new simplified method for the home office deduction. So rather than keeping track of that laundry list of expenses before, you can just deduct the number of square feet of your home office times $5, as long as it's 300 square feet or less, and you can take that as your deduction. Then you don't have to worry about tracking all those expenses. You don't have to worry about the depreciating, 5 or 10% of your home, and all the hassle that goes with that. This is, again, depending on your situation, hiring your children could save tax. Of course, you have to actually give your children the money, so there's a downside. And of course, the children, your child actually has to work for you. It's not just on paper writing them a check. But if you do have a reason to employ children that are under the age of 18, then they're exempt from the self-employment tax and from unemployment insurance. And if they're, for example, so if you pay them, this number changes a little bit every year, but you can pay them $6,000 this year. If that's all the income they have, they would have zero income tax. Or if you have that on top of your other income, you're going to pay income tax on that. Okay, so move on from that. HSAs, or health savings accounts, are an increasingly popular way to save for medical expenses, and you have to have a certain type of health insurance to qualify to have a health savings account. But that's a great tool, especially if you have low medical expenses. Then you'll get a lower premium, but you'll have a high deductible, and then you can be saving money into your health savings account. And all the money that goes into that health savings account it's owned by the employee, or the owner of the account, just like any other bank account. The money can only be used for medical, but it can be used. It doesn't have to be used this year. It can be used any year in the future for medical expenses. And if you have a balance within that account, you can also invest in mutual funds or other things, depending on what bank holds that account. So you can actually put money in that and let it grow, and then in retirement, once you pass the age of 59 and a half, then you can pull that money out without any penalty. And if it's for medical expenses, you pay zero tax. If it's not for medical expenses in retirement, you just pay the normal tax. So it's similar to an IRA in that way. There's a small employer health insurance tax credit now for if you have less than 25 employees and you pay them on average less than $50,000, but you are providing medical insurance benefit for them, then you may be eligible for this credit. Business expenses. Skip over that. Here's some examples when, as you're doing your bookkeeping, it's important to make sure you keep track of the expenses that have a different tax treatment or that are not deductible. Make sure you keep track of those separately. So we have the 50% meals and entertainment, and then there's also other things there like life insurance premiums. If the business is the beneficiary, often if there's multiple partners, we have a buy-sell agreement where the business will get a settlement if one of the key employees or one of the owners dies. So those are not deductible. And then if you do have to cash in life insurance policy, the proceeds aren't deductible either. So if you make a mistake and deduct those premiums along the way, the IRS is going to tell you that now that you got your $1 million proceeds, how are they going to tax that? So, important detail there. Let's see.
Well, student loans through a business, or if an owner or an employee is going to school, and the employer is paying for that, are those fine deductions?
So the employer is paying
Yeah,
for the school?
legal deductions for that.
Yeah, there is a, yeah, so generally with like a tuition reimbursement plan or the employer's paying for tuition, they can pay for up to, it's 5,000 and some change is the limit per year that an employer can pay. Yeah, you can get a deduction and the employee doesn't recognize that as income. So there are some special rules on that with, you know, if it's for the owner or the owner's child, then there could be some hurdles to get around there.
Okay.
So on documentation, we say document everything. Save all your receipts, and meals and entertainment is an area that the IRS likes to look at, and make sure you document the place, the business purpose, and it's a good idea to write down who's there. So if you know, if you go to lunch, pay for a lunch, you know, just on the receipt, write, you know, here's who the people, you know, these are the people that were there. We discussed, you know, whatever subject. And then for the length of statute for taxes is 3 years. Generally, is the time period that you can be audited. Once 3 years is passed, and generally can't audit prior to that. For legal statutes, it would be 7 years. It's pretty difficult for you're required to keep business records. But I was keeping forever, especially if you have them electronically. There's no reason to go delete old records. And then here's just a few other miscellaneous deductions or credits that you can get. And so those are, you know, some to be aware of. And let's see, I think that's the last slide I have there. And then I have some questions that Connie sent to me that some of you submitted on a survey, and so I have a list of those. Some of them we went over in the presentation, but not all of them. So it's now open up to any of you that have any questions on anything there that we talked about, or any other tax questions. And if nobody has any, then I'll go through a few of these that were asked.
I wasn't sure on the vehicle, the truck is just if it's over a certain weight, the 25.
Yes.
600 pounds.
So how big are the trucks then?
That should be
3/4?
Yeah.
Half ton?
That should be yours, but also
Okay. And so let's say you have that, and is that of actual expense, or is that, how does it, what can you deduct there? I'm not very.
So, okay, so it's the actual cost. So if you only pay $20,000, then you could deduct the full $20,000 in the first year. Or if you paid, if you paid $30,000, then with a $25,000 max, you can deduct $25,000 in the first year, and the $5,000 that's left, you spread out over the 5 years.
Okay, and then if you do that, you cannot take the mileage? Are they mutually exclusive?
Yes.
Okay.
Yes. Yes, it's one or the other. And, I mean, there's some more, you can get into where you take part of the mileage, but not the depreciation portion. And, you know, so you can take the depreciation, but then take a smaller per diem for the rest of the expenses.
back to the kid situation, when you have your children that work with you that are under 18, like one of my sons does my video editing, the other son does the camera work. Now we started developing more high quality videos where we've actually hired a production crew, and obviously that situation is different. But when it comes to the kids, if they make, is it less than $6,000 a year that they don't have to declare taxes on that, or have you explained that again?
Sure. Yeah, so it's, it was 6,100 for 2013, and that amount, creeps up every year. And so that is on, so if the child is employed by a parent, and so for example, if you're taxed as an S corporation and you employ the child directly, then technically the child's not employed by the parent, it's employed by the corporation. Or so if you're a sole proprietor, or if you have an LLC, or if you and your wife are the sole LLC members, then that would qualify. If it's you and someone else that's the LLC members, then that doesn't qualify.
So it's kind of like something you can do kind of under the table, or, I mean, I don't know if that's necessarily a good word.
So, that's not a good word. No, under the table usually is referring to
In a courtroom.
evading. We try to avoid taxes, but not evade taxes. So it's totally, it's completely legal, so you actually issue them a W-2 and everything. And so the W-2 would just have, box 1, 6,000 of wages, and then where it has, Medicare wages, Social Security wages, those are just zero. No tax on
My
that.
account usually handles it all, so I don't really know all the details, so I should probably prefer.
And if you do have an S corporation, for example, and you want to pay your kids, but you can't because the corporation is the employer, you can set up another entity. So, for example, I have a client who's a dentist and has an S corporation, and so his wife has a cleaning business where she is the sole proprietor. The dentist office pays a fee to the cleaning service of, say, $12,000. So the S corporation gets a deduction. Now on the wife's cleaning business, she has $12,000 of income, and she employs her 2 kids to go and clean, pays them each $6,000. So her business nets 0, and the 2 kids each have the $6,000 tax free. So you can, if you structure it right, you can make the result.
What's the time frame in which the IRS will declare you a hobby-based business? If you're generating 0 profits for a number of years, isn't there a time frame for that?
Yes and no. So on hobby versus business, there's so for benefit of everyone else, if you're a hobby, you have a hobby, and then you're taxed on the income and the deductions. You can take the deductions, but they're limited. And if you have a loss on a hobby, then you don't get to deduct that. For the business, of course, you can always deduct your losses. So you want it to be a business, not a hobby, right? So there's a list of there's a laundry list of factors that they consider, and so one of those factors is how many years you've had a loss or had a profit, and so it's so there's not an exact number of if you've had a loss for 5 years, you're a hobby and you can't take business deduction. Okay. You can be a legitimate business if you have all the other factors in line. There's businesses. You look at I don't call it businesses, but there's national businesses that lost money for decades, right?
So that's fine. So this lady who has the cleaning business, even though she has 0 profit every year for 15 years, but she has a legitimate cleaning business, that they would never consider that a hobby-based business.
No, not based on that alone, not if she had everything else in order.
Okay. Do you know where I could get a list of those things? Because I meet with a lot of people who ride that line
Okay.
between hobby-based business and actual business sometimes. And so, they make a good amount of income, but, they're continually deducting. But is there a resource for that? Maybe I can find it.
Yeah, I don't have it off the top of my head, but I can send you one.
Okay.
Give you a card or contact info. I can send you one. And also for anyone, if anyone wants a copy of these slides, I can send you a PDF of them if you want your info afterwards. Any questions?
Can you review again the square footage method for home base?
Yeah. Let's see, so the new rules or the
Yeah.
new rules? So that is you take the number of square feet of the business use. So if you have a 10 by 10 office, it's 100 square feet. And then it's just the number of square feet times $5. So if your home office is 100 square feet, your deduction is $500 for your home office.
Per month, per year?
That's per year.
Per year.
Per year.
Not very much.
No, yeah, per month would be nice.
Is there a cap on that?
There is, it's 300 square feet, so that'd be a $1,500 deduction.
So above that, where do you fall in? You get like 600 square feet you're using in your home. What do they consider you then? How do you deduct that?
So this is the new simplified method. You can still use the old method. So if you had 600, you could say, if you don't want to bother, you could just take the 300 of it and get a $1,500 deduction, or you could go through the old calculation with all the expenses and take 10%. So, they come out with a simplified method, which really makes it more complicated, because now you have to run both scenarios to see which one gives you a better tax answer, right?
Okay.
Any other questions?
I have a payroll question.
Okay.
So we, I guess for lack of a better word, we sort of lease our employees at the town. For example, Joseph Shop employs a graphic designer. He has a shell company that uses your services too. His work, actually, same company. He does, okay, so for his clients, they do graphic design, we pay her a little extra for work on this side. I'm trying to figure out, I want to pay her what these clients of his are paying her, this extra wage, but I'm paying extra taxes on that. It's a lot higher wage than we get. Is there a percentage that we can increase it by to charge these customers? Say I would pay her $20 an hour to do a special project for these customers of his. We don't want to charge them $20 because I'm paying taxes on this as well. How much should I increase it by to charge them? Does that make
Okay,
sense?
I think so. Yeah, it's, so 8%, well, 8 to 10% is probably in that range. There's not necessarily an exact number because the unemployment insurance, that rate varies based on your business. So if you do that rate, then the Social Security Medicare is 7.65%. So if you know your unemployment rate, add that onto it. And that's, so it'll probably end up between 8 and 10%. But, yeah, no problem. So one of the questions was what are common red flags the IRS looks for when determining to audit a business? And so one of at the beginning we talked about the entity choice, whether you're a sole proprietorship or LLC as a partnership or S corporation. And actually not as necessarily a red flag, but the audit rates based on the different types of businesses. If you are filing a Schedule C, an individual tax return, then you are 5 to 10 times more likely to be audited than if you're filing a partnership or that's based on their audit rate. So it was, I don't remember what the exact percentages were. I think it was about 2% for a Schedule C, and then or it's 2% for a Schedule C with income under 100,000. It was actually 4% chance of being audited if you have over 100,000 under Schedule C. And then for partnership or S corporation, it's only a 0.4% chance of being audited. So my guess is that's just because if you're filing a Schedule C, then they assume that you're a less sophisticated, more, kind of trying to figure it out on your own, more likely to, to make mistakes or conduct things that you shouldn't be. And so you can still do it by yourself, just still do it on your own, but if you're filing a partnership return, you cut your audit risk dramatically.
Is there an income bracket there, like companies that make over $1 million, the IRS is, aside from your business structure, does the IRS look at companies that are in certain income brackets, do they audit more?
They do, yeah. I don't have those statistics with me, but if you're, I think the highest one, that I don't know what the number is, but huge corporations, they're audited. They have like a 40 or 50% chance of being audited. The giant companies, they audit a lot of them every year,
But like small home-based businesses under 100,000, you know what that rate might be?
So the large companies that I refer to, those would all be C corporations. So for partnerships and S corporations as a whole, which virtually none of those would be the huge ones, then it's 0.4%. Okay. And I don't think they do break that piece up by income. Okay. So on S corporation, one audit red flag is if, we talked about how you pay yourself a salary, and then you avoid the self-employment tax on the difference. Some people set that up and don't pay themselves any salary, so they avoid self-employment tax on the whole thing, which is wrong. But there's a reasonable salary, and so they say, well, I'm going to say 0, which anyway, so that's a big red flag, and that's a line on the front page of the return, officer salary. Give a 0 there for S corporation. Chances go up a lot, which means if you do have a salary, the average is 0.4%. So if you do have a salary, then you probably, in S corporation, would be below 0.4%. Okay, any other questions?
On your salary for an S corp, does it have to be fixed? Say you're just starting out and your income kind of goes up and down. Do you adjust for that, or?
Yeah, it doesn't have to be fixed. And they're, usually when they look at salary, if you have any number there, that looks a lot better than 0. But then, if they do look into it, they're generally just looking at the year as a whole. So whether you pay yourself monthly or if you, some people just do one big check at the end of the year, which is usually still okay. But even year to year too, if you need to fluctuate, you can do that.
So with the LLCs, it's member draws, right? Instead of a salary, you can just do member draws. Is that correct? And then, I know I've done this several times, but as far as the way that's taxed at the end of the year, where does that go on your tax forms, your member draws? Or does that just all get your flat number on what your net income is, and that moves over to your 1040? Is that right?
That's right.
Okay.
Yeah, so your draws usually don't matter.
Okay.
It's what your net income is that you're taxed on. Okay,